The first couple of rate cuts always have the most effect. So that'll be the most dramatic. So I would suspect the first 2, 3 cuts, you're going to see pretty dramatic moves up in gold and silver and down in the US dollar.
Oh,
After
okay.
that, I think they become a little bit more muted over time, but it all based on economic news. So if the economic data continues to be bad and starts to deteriorate, then they'll start to price in the additional cuts. I think we're heading into one of the best years in the mining sector, maybe in my entire lifetime. We're going to see interest rates go down. And at the same time, you're in a situation right now where there's huge amount of demand, but supply is getting tighter and tighter. They've got enough gold and silver in inventory for one small bull market. So if gold moves from 21 to 2,300.
In a recent analysis, president of Parilla Investment Group, ThomasParilla underscores the remarkable resilience of gold prices in the face of rising interest rates and a substantial 140 million ounce silver deficit. Despite the elevated interest rates throughout the year, spot gold concluded the final trading day, 2023, at $2,063.45, defying expectations and prompting many analysts to predict further gains in the upcoming year. Gold investors anticipate record high prices next year, buoyed by the fundamentals of a dovish shift in U.S. interest rates, ongoing geopolitical risks, and continued central bank buying. This positive sentiment comes from a volatile 2023, where gold managed to weather the storm and emerge with strength. On the silver front, 2023 is noted for its volatility, but no decisive price breakout. Despite anticipated U.S. interest rate cuts and global tensions, silver prices are poised to end the year where they began. As 2024 approaches, all eyes are on the Federal Reserve's decisions and the potential for lower interest rates. Notably, the U.S. dollar is on track for its weakest annual performance in 3 years, further enhancing silver's appeal to holders of other currencies. Parilla emphasizes the potential impact of economic data on the markets, suggesting that if economic conditions continue to deteriorate, additional rate cuts may be introduced, influencing the trajectories of gold, silver, and the U.S. dollar. Looking at the technical aspects, the key resistance for the gold-silver ratio is identified at 88.00. A breach of this level could propel the ratio toward 92.00, signaling a bearish outlook for silver. On the support side, the gold-silver ratio finds robust support near 78.50, presenting an opportunity for potential upside momentum should the ratio approach this level. Parilla expresses a sense of significance as the ratio approaches this level, suggesting that the situation for silver is becoming quite drastic. Let's delve into key moments from ThomasParilla interview with these video clips.
The first couple of rate cuts always have the most effect. So that'll be the most dramatic. So I would suspect the first 2, 3 cuts, you're going to see pretty dramatic moves up in gold and silver and down in the US dollar.
Oh, okay.
After that, I think they become a little bit more muted over time, but it all based on economic news. So if the economic data continues to be bad and starts to deteriorate, then they'll start to price in the additional cuts.
Right.
We just had the dollar drop from, the dollar index went from 106 to 100 just in the last 2 months.
Oh, that's crazy.
Yeah, almost a 6% drop. Now you start pricing these other rate cuts that are coming. I'm very convinced we'll see the dollar index drop to 90 fairly soon, and then after that, slowly make its way down to 70. But you can see how dramatic of effect it had, though. I mean, just going from 106 to 100 during that same period, I keep an eye on some of the leveraged gold funds like Nugget and UGT.
Okay.
That went up about 50% during the same time period. I think we're heading into one of the best years in the mining sector, maybe in my entire lifetime. We're going to see interest rates go down. And at the same time, you're in a situation right now where there's huge amounts of supply, of demand, but supply is getting tighter and tighter.
You mean on the mining side?
On the mining side, yeah. And even on the dealer side. I mean, the dealers that I talk to, I think they've got enough gold and silver in inventory for one small bull market. So if gold moves from 21 to 2,300, the gold to silver ratio right now, I think the last time we spoke, it was around 80. Now it's about 85. And we're getting to the point now where silver is getting very drastic.
Undervalued.
I can remember at one point I seen it go down where the ratio was 90. And that was at the point back when silver went down to as low as like 13 and then turned like a rocket and went to 29. I think we're entering like a different paradigm now because we've never been able to compare the gold and silver ratio to a point where we have U.S. debt. you can look at it and say to yourself, should it be at par? No, that doesn't make any sense. But I mean, should it be at 100? I think you're going to see now a whole different economic plate put in front of us that people are going to have to now start to reevaluate. If you look at Mexico right now, we get a lot of silver out of Mexico. Production dropped quite a bit last year there. I think what will happen is if you get silver up to say 30, 35, then you'll see a spur where you'll see a new round of production come in, because exploration, it'll be worth it. Some mines that maybe aren't economically feasible when it's at 25 will be when it's at 35. And so, there's that old saying, what's the cure for low prices? Low prices. Because it'll spur on more activity.
Yeah.
But right now, if you look at silver, the all-time high we hit in 2011 was $49.51.
Okay.
Now, last year, global silver demand increased by 10%, but global mined silver decreased by 2%. That's a pretty drastic difference right there, 12% offset.
In 2024, the banking industry is poised to confront a series of formidable challenges, including surging interest rates, a rise in delinquencies, unpredictable inflation, and stringent capital requirements. These factors collectively pose a threat to the profitability of banks, exerting pressure on their margins. ThomasParilla asserts that the challenging state of the banking system may necessitate a proactive approach from the Federal Reserve, potentially involving rate cuts to avert a potential collapse. Reflecting the uncertainty in the financial landscape, U.S. Treasury yields experienced fluctuations on Wednesday. Investors closely examined the outlook for monetary policy and financial markets in the upcoming year. Notably, the yield on the 10-year Treasury witnessed a notable drop of nearly 10 basis points, settling at 3.789%. Simultaneously, the 2-year Treasury yield edged down by 5 basis points to 4.238%. Parilla's insights into the relationship between interest rates and Treasury prices gain relevance in this context. If interest rates decline, Treasury prices could see an upswing, offering a potential remedy to the prevailing challenges the banking sector faces. Let's get back to the interview.
I would prefer not to cut rates, but they got the banking system in such a mess where it's hanging on by a thread that they almost have to cut rates in order to save it. And they walked the 10-year, the 10-year note, that got up over 5%. Right now it's down to like 3.85. I think they had to bring it back down because the treasuries in those banks were so underwater. You were talking about billions. I mean, they're saying that even on the commercial real estate side, the devastation there, the banks are going to take like $160 billion hit. But I hear it could be maybe as high as like 500 to 600 billion. I mean, there's some really choice places inside our big cities that are going at like 50% discounts. Somebody's going to eat that. In a situation like that, you've got the same scenario playing out only in U.S. Treasuries, and the banks are holding them. So the government's working more with them because they have to. Otherwise, they know they'll lose the banks. And that's what happened with Silicon Valley. When it went down, people figured out they were upside down on their treasuries. And then all of a sudden the rumors started that they were short on cash.
Right.
What people found out is the cash really isn't there. And that's true of all of our banks. The only thing holds our banks together is confidence. If you're confident that the United States government will back them up, and that it's a safe institution, well, then, the bank's fine. But if everybody lined up tomorrow morning and said, hey, I want my money out, that's it. The bank doesn't have it. You can say that the bank's been bailing them out all along right now because they're doing that overnight repo situation where they're backing the treasury. And all that's doing is that's allowing the banks to have liquidity so they don't have to sell those treasuries and they can just hold them. I think the government will have to continue it until rates come back down. If rates come back down, of course, then treasury prices will go back up and that problem will go away on its own. And I think that's what they're trying to do. They're trying to buy themselves enough time. And some of those treasuries, you figure, will reach maturity. And when they do, they'll come back to par. And that's the thing about the way a bond trades. If you bought a 10-year bond, it'll have a lot of volatility in the actual price initially. So if you put 100,000 in and interest rates went the wrong way, maybe a year later it's worth 70. So 7,000. But what will happen is the volatility will get smaller and smaller as you get closer to the end when it goes back to par.
Like the 10-year?
Yeah, all of them. 10-year, 30-year, all of them. It'll look like a wedge, go like this.
Right.
So the volatility is at the beginning, and then it gets smaller and smaller until you get here. And then it'll go back to 100. People are watching the repo market and trying to figure out, okay, what is going on here? Why are these numbers so haywire? And that's what was going on.
Wow.
They're backing them completely, and they're not calling it a bank bailout because they've done all their studies where that's a red hot word to use. So they're staying away from it. But make no mistake about it, they've been bailing the banks out ever since Silicon Valley went down. And my
Wow.
guess is they would have lost at least 3 or 4 banks during that period, and all the regionals would have been in trouble.
As the banking industry braces for challenges in 2024, how might the Federal Reserve's potential decision on rate cuts impact the sector's ability to navigate rising interest rates and other threats to profitability? How might the anticipated moves by the Federal Reserve, coupled with potential economic data deterioration, shape the trajectory of precious metals in 2024? And what strategies could investors consider amid the evolving dynamics of gold, silver, and the US dollar? Share your thoughts in the comment section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.